Hello, I'm Andrew Marshall. In this video, we're going to take a look at how receiving a pension influences your income taxes. For retirees with a pension, understanding how that income will be taxed is crucial for financial planning. Most pensions are funded with pre-tax dollars, meaning withdrawals are fully taxable as ordinary income. That means they use the same tax brackets as your wages. This applies to pensions from government jobs, private pensions, and military service. What I want to show you first is a typical example for how someone's income taxes look just leading up to retirement, after retirement, and then later on when they have started their RMDs. This diagram shows a typical example for what income taxation looks like when you do not receive a pension. On the left side of this diagram, the blue shaded area is showing their taxable income because they're going to be working for 2 more years. So their taxable income puts them into the 22% federal tax bracket. Then after they retire, their income essentially will drop to zero because they may have investment income from their accounts, but their tax write-offs, their standard deduction will cover that income, and so they would be paying no taxes in those years. Another point here is that we see no income tax being paid between age 67 and 70, which is when they would start their Social Security payments. But if your other incomes are low, Social Security is tax-free. Eventually, in this diagram, we can see that once they're in their 80s, they would be back up into the 22% federal tax bracket. In this diagram, I have added $60,000 of pension income beginning at retirement, age 65. And you can see that it has made a difference because the blue shaded area after retirement is much taller, meaning they're going to pay more tax every year. So again, same as the other diagram, they work 2 more years and then their income drops off. In this situation, they retire, they have $60,000 of income for a couple of years. That's more than they would have without the pension income, obviously. So we see a little bit of the blue shaded area just after retirement. Then I'm assuming they both claim Social Security at 67, the full retirement age, and I've assumed $50,000 each. So beginning at 67, you can see that they pay higher taxes because they're going to have $100,000 of Social Security income combined, plus the $60,000 pension. Because they now have pension income, their Social Security will be taxed. Because again, Social Security is taxed based on how much other incomes you have. So we can see from 67 till the early 70s, they're taxed on their Social Security and their pension income. Then they begin RMDs, and all 3 of those incomes now are taxed. So the pension income is just like the base throughout their entire retirement, and then their other incomes are stacked on top of the pension income. I think this diagram is really helpful. So we can see that they're working for 2 more years, then they retire and they start their pension income. The pension income is the purple color, and it continues for the rest of their lives. Once they start Social Security, the pension and Social Security both are taxed, whereas for someone without a pension, their taxable Social Security in these years could be 0, depending on how much other investment income they have. Then, once they start RMDs, everything is taxed. They've got their pension, their Social Security is taxed, and their RMDs are taxed. RMDs are withdrawals from tax-deferred accounts. For pension people, a lot of times this could be a 403B account or a 457 account. And so you can see here that basically taxes keep going up throughout their lifetime. The pension really does increase your taxable income from when you begin the pension until the pension ends, which is the end of your life, most likely. So, do you receive a pension? How has it affected your taxes? Please let us know in the comments below. Also, please consider subscribing to the channel. Thanks for watching.